Okay, so chances are you're gonna fit into one of two categories. You've been thinking about buying your first home, but let's be real, the mortgage process feels like a whole new language. You're hearing talks about down payments, interest rates, something called PITI, and you're like, what is that? Or maybe you're on the opposite side where you're getting ready to sell or thinking about selling, and you're trying to figure out, okay, if I get an offer, is it best if I accept an FHA offer, a conventional loan? Should I accept a VA loan, or does it even matter? Or maybe you're not necessarily at the point where you want to sell, but you are trying to figure out what is your home equity and how do you get it out of your house, and if there's a faster way for you to pay off this thing called a mortgage. Well, guys, no matter where you are in your home ownership journey, this video is for you, because in this video, I'm going to bring you a masterclass. Yes, I said a masterclass. I want you to get your pen and your notebook, because today I'm going to break down everything mortgages. I'm talking everything that you wanted to know about a mortgage, from how they work to what happens when you close, everything that's important before you sign on the dotted line. And guess what? If you've already signed on the dotted line, I'm even going to have some tips to help you understand your mortgage better. I'm going to talk about how you can pay your mortgage off faster and cut years off of your loan. So you don't want to miss this video. Mortgages don't have to be scary. They don't have to be confusing. I promise. In this masterclass, I'm going to give you everything you need to know. So let's get into it. All right, so let's start with the basics. What exactly is a mortgage? I want to keep it really simple. A mortgage is your VIP pass to home ownership, friends. It's a loan that you're going to get from a bank or a lender that's going to help you buy a home. Because let's be real, most of us are not walking around with hundreds of thousands of dollars under our mattress or in our own bank accounts, just chilling to where we can go buy the house that we want. So here's how a mortgage works. The lender is going to give you the money to buy your home, and in exchange, they're going to place a lien on your property until you've paid off the loan. So even though you're a homeowner, you technically don't fully own the home until that last mortgage payment is made. And sometimes that can be 30 years or more. So you're just not going to pay back the money that you borrowed. That's called the principal. You're also going to be paying back interest, which is basically the lender's way of saying, hey, thank you for borrowing this money from us, and here's what it's going to cost you. That's what really a mortgage is. Now, this is where your credit score, your income, and your debt are all going to come into play, because the better your financial profile, the lower your interest rate. And a good rate can save you thousands over the life of your loan. So when you think of a mortgage, I want you to think of it as a powerful tool to help you achieve your dream of home ownership. But like any tool, it works best when you understand how to use it. And this video, we're going to break down every single thing for you. So let's talk about mortgage approval, because whether you are buying or selling a home, this is actually where everything begins. See, there's a difference between getting pre-qualified and getting pre-approved. And I need you to know the difference and why it matters. You see, a pre-qualification is just a quick estimate of what you might be able to borrow. There are no documents required. There's no real verification, like not looking at your bank accounts or anything like that. It's just a basic lender or a system, an algorithm per se, that's going to put a few numbers together that you give them and tell you, yeah, this could work. It's easy, but let's be real. It doesn't hold much water. It's kind of like getting those pre-approval credit card offers in the mail. They've never looked at your information, so when you call them, guess what happens? Nothing, because you're probably not qualified. A pre-qualification would not even get you in the door for a home tour, okay? But a pre-approval, that's the real deal. A lender's actually going to verify your financials and give you a specific loan amount, an estimated mortgage payment, and proof that you are a serious buyer. Guys, I don't even show a house without somebody being pre-approved. I don't feel like wasting my time. I don't feel like wasting the seller's time. And honestly, I don't want to waste the buyer's time. I love helping people find their perfect home, but I also respect everyone's time. There's no point in you falling in love with a house that you cannot afford. So if you're serious about buying, then show that you're serious by doing the work up front and getting your pre-approval. Now, let's flip this over to sellers, because this matters just as much on your side. You want to make sure that the agent is only letting buyers into your house who are financially ready to make an offer. If they are not pre-approved, then they're just window shopping. Why are you going to sacrifice your day and your time and have a bunch of looky-loos just touching all of your stuff? It doesn't make sense. A buyer who doesn't have their financing in order is not in a position to submit a strong offer. And that means they could end up wasting your time. Buyers with solid pre-approvals are the ones who are ready to move forward. Now, if you're a buyer, a pre-approval does two big things. First, it ensures that you are shopping for homes that you can actually afford. Second, in a very competitive market, sellers are going to take your offer more seriously when you're fully pre-approved. Think about it like this. If you were selling your home, would you rather accept an offer from a buyer who has all of their financing locked in, or from someone who's still figuring stuff out? Do you want any random person just walking around your house when they can't qualify to buy it? Yeah. Exactly. So if you're ready to get pre-approved, here's what lenders are going to be looking at. They evaluate 5 key things: your credit score, your debt to income ratio, your employment history, your income, and your available funds. Now, I'm not a lender, and every lender has their own guidelines, but in general, these are the biggest factors. Now, your credit score is going to determine what kind of loan you can qualify for and what interest rate you're going to get. The higher your score, the better your rate. For most traditional loans, you need at least a 620 credit score, but FHA loans allow for some scores as low as 580. But friends, listen, you know I'm always going to keep it real. Just because you can buy a house with a 580 credit score, that doesn't mean that you should. The higher your credit score, the less you're going to pay in interest over time, and that can save you thousands of dollars. Now, lenders are also going to look at something called your debt to income ratio. They may refer to this as a DTI, which is a fancy way of saying how much of your monthly income is already spoken for. See, they want to know how much you're paying in credit card debt, in car loans, in student loans, or any other monthly debt. Ideally, your total debt, including the mortgage, should be under 43% of your income. Now, if your debt is high, it can limit how much you qualify for. So if you're carrying a lot of debt, it's worth it to work on paying it down before you actually start the home buying process. But that's something that we can talk about once we get you started. Now, employment history is another big one. Lenders like stability. That means they want to see at least 2 years of steady income. If you just started a new job, if you just switched careers, or if you got fired, that's going to impact your approval. So did you know that even if you get a promotion and if that involves changing companies, that can sometimes create an issue? If you're thinking about making a career move, check with the lender first if you know that you're going to be interested in buying a house in the next year or two, so that you know how it could impact your ability to qualify for a mortgage. Now, your income matters whether you're a W-2 employee or if you're self-employed. If you work a traditional job, lenders are going to want to see recent pay stubs, tax returns, and bank statements. If you're self-employed or if you earn a 1099 income, you need at least 2 years of tax returns, profit and loss statements, and sometimes bank statements to show that you have consistent income. And if that sounds like a lot, don't worry. When we go over loan options later, I'm going to talk about bank statement loans, which can be a great option for business owners. Lenders are also going to want to see your proof of funds for your down payment and closing costs. So even if you're using a low or no down payment loan like an FHA or a VA, they still want to see that you have some savings in the bank. So having some financial cushion is going to make you a stronger buyer than not having any money at all. Now, if you're selling a home, it's important that you understand what buyers have to go through to qualify so that it can help you evaluate their offers. A buyer with a strong pre-approval and a higher down payment is much less likely to hit financing issues, which makes for a smoother closing process, and you don't have to worry if they're going to not be able to get qualified at the last moment. And if you're buying, knowing what lenders look for helps you prepare in advance. If your credit needs work, if your debt is high, or if your savings are low, you can start making adjustments now so that when you're ready to buy, you are in the best possible position. Bottom line is this, friends. A pre-approval is not just a step in the process, it is the foundation of everything. So whether you are buying or selling, getting pre-approved first saves you time, makes you a stronger buyer, and helps ensure a smooth transaction. There's a scripture that says, if the foundations be destroyed, what can the righteous do? So I want you to think about this as your foundation. So before you start looking at homes, get your finances in place. It is the best thing that you can do to set yourself up for success. Okay, so we've talked about the difference between a pre-qualification and a pre-approval. Now let's talk about something that's going to play a huge role in your monthly mortgage payment, your PITI. PITI stands for principal, interest, taxes, and insurance. These 4 things make up the total amount that you're going to pay each month to your lender. If you've ever wondered why a mortgage payment is higher than the loan amount, this is why, and I'm going to break it down for you. First, First, we're gonna have your principal. The principal is the actual loan amount that you are borrowing from the bank. If you're buying a $300,000 home and putting 20% down, your principal loan amount would be $240,000. That's simple enough, right? But then, let's watch out, because there is the interest. Interest is the cost of borrowing that money from the bank. Your interest rate is going to be based on several factors, including your credit score and the current market rates. The higher your credit score, the better your rate, which means you're going to pay less in interest over time. Does that make sense? Next up, we have your taxes. This is your property tax, which is based on your home's assessed value and your city or county's tax rate. And this part is especially important if you're buying a home in Hampton Roads, because property taxes can vary widely depending on what city you choose to live in. And finally, we're going to have insurance. That's going to include your homeowner's insurance, which protects your home in case of a fire, a theft, or damage. If you're putting down less than 20%, you're also going to have to pay private mortgage insurance, or PMI. PMI protects the lender in case you default on your loan. So let's go back to property taxes for a second. Property taxes are a huge part of your PITI, and here in Hampton Roads, they're especially important because tax rates can vary a lot from one city to the next city. So property taxes are what fund things like local schools, the police, the fire department, the roads, and the public services. They're going to be based on your home's assessed value, which is what your city or your county says that your home is worth, and not the local tax rate. But here's where it gets interesting, friends. Let's take Norfolk, for example. Norfolk's tax rate is $1.25 per $100 of assessed value. So if your home is assessed at $300,000, your annual property taxes would be $3,750. But let's look at Suffolk. Suffolk's tax rate is $1.07 per 100 of assessed value. That same $300,000 home in Suffolk would cost $32.10 in property taxes per year, over $500 less than living in Norfolk. But here's another thing that most buyers don't realize, that even if the tax rate does not change, rising property assessments can still increase your tax bill. Norfolk, for example, saw home values rise nearly 6% last year. That means even though the tax rate stayed the same, homeowners still ended up paying more. Now for buyers, this is directly going to affect how much house you can afford. Your property taxes are included in your monthly mortgage payment. Your lender collects them and holds the money in an escrow account to pay the taxes when they are due. That means a home in a higher tax area could cost you more per month than a similar home in a lower tax area, even if the purchase price is the same. Does that make sense? I hope you guys are getting the numbers here and the difference in what we're looking at. But let me talk to sellers for a moment. For sellers, understanding property taxes is just as important. Buyers don't just look at the price of the home, they look at the total cost of owning it. So higher property taxes can make your home less attractive to buyers because property taxes increase their monthly payment. But on the other hand, tax-funded improvements like better schools, safer neighborhoods, and upgraded infrastructure can actually increase property values and make your home more appealing. See, I had a client in Chesapeake who sold their home and moved to Suffolk because their property taxes had gone up so much. That move saved them hundreds of dollars a year and made their monthly mortgage payment much more manageable. See, the bottom line is this, friends. Property taxes are a major factor in home ownership. So whether you are buying or selling, understanding how taxes are calculated and how they fit into your budget can save you money and help you make better decisions. So have you been thinking about relocating to Hampton Roads, Virginia? I've got just the thing for you. My team and I have actually taken the time to create the ultimate relocation guide, which is meant to save you hours of research, and I've linked it down below. From top employers, the best hospitals, and a boatload of other things that you need to know before making the move to Hampton Roads. And the best part, guys, it is 100% free. That's right, you heard me, it's 100% free. So just click on the link in the description or the top pinned comment. I hope it helps. God bless you. Okay, so now that we've talked about PITI, let's talk about the different types of mortgage loans available, because choosing the right loan is not just important for buyers, it's something that sellers should understand too. You see, the type of loan a buyer uses can impact how long the transaction takes, it can impact the appraisal process, and even how attractive a buyer's offer is. Whether you're buying or selling, knowing what's out there gives you the competitive advantage. Let me explain. Let's start with conventional loans because these are the most common. Conventional loans work best for buyers with strong credit and stable finances. If you have good credit and can put at least 5% down, a conventional loan might be the way to go. They are straightforward, they have fewer fees than government-backed loans, but they do require a higher credit score. If you're putting down less than 20%, you're also going to have to pay private mortgage insurance, or PMI. Now, if you don't have perfect credit, or if you don't have a large down payment, an FHA loan might be a better fit. FHA loans are great for first-time home buyers because they allow as little as 3.5% down. But when you're thinking about an FHA loan, and many buyers don't know this, there is a trade-off. You see, FHA loans require mortgage insurance for the life of the loan, which is going to add to your monthly payment. It's a great option for getting into a home, but you have to factor in those additional costs. Now, if you're military, thank you first and foremost, God bless you. VA loans are hands down one of the best loan options out there. There's no down payment, there's no PMI, and it is a huge win. My military buyers love them. The only thing to keep in mind is that there's a VA funding fee, which is an upfront charge, but it can be rolled into the loan. And here in Hampton Roads, VA loans are everywhere because of our military population. So if you qualify, this is definitely a loan worth considering. Now, we also have a USDA loan, which are designed for buyers in more rural areas. Just like VA loans, no down payment is required, but there are income and location restrictions. Now, if you're open to living outside the city in areas like Suffolk or Isle of Wight, this could be a great way to buy a home with very little upfront cost. Now, I don't want to leave out my self-employed buyers because I know firsthand as a self-employed realtor that getting a mortgage when you're an entrepreneur can be a little trickier and a little bit longer of a process. And that's where bank statement loans come in, my friends. If you don't have a traditional pay stub or a traditional W-2 job, a bank statement loan will allow you to use your bank statements to verify your income. They offer more flexibility, but they often come with higher interest rates because they're considered riskier. If you're self-employed or if you're a 1099 contract worker or independent contractor, this is something to discuss with your lender to see if it makes sense for you. Now, that's going to bring us into grant programs. These can be a game changer for first-time home buyers, but they do come with a few things that you need to know. Hey guys, as much as I love making these videos, there's one thing I love more, and that's helping families and people from all over the United States and the world make the move here to Hampton Roads, Virginia. I've helped countless families make the move here. So whether you're coming out next week, next month, or even next year, don't hesitate to reach out. Our contact information is right here on the screen, and it'll be linked in the description in case you missed the on-screen pop-up. I look forward to helping you and your family make the move to Hampton Roads, Virginia. God bless you. Now, the positive is grants can help cover your down payment or your closing costs, and that gives access to home ownership to more people because it makes it more affordable. But they do come with more qualification criteria, and some require that you take a home buyer education class, which are great classes, by the way. Now, sometimes lenders are hesitant to deal with the extra paperwork, but I always encourage my clients to explore all of their options, even if it means a little bit more work for their lender. I've had buyers who almost missed out on grant money because their lender was not familiar with the program, and that's why having an experienced lender matters. I make sure my clients know what their options are, and I work with top lenders who are willing to go the extra mile to get them into the best loan for their situation. And that brings me to another key point, that not all lenders are the same. A good lender is not just processing your loan, they are guiding you toward the best option for your needs. It's about you, not about them. So whether you are best suited for a conventional, an FHA, a VA, a USDA, or grant programs, whatever, your loan choice is personal, and it's up to you to meet the guidelines, but a great lender is going to make that process as smooth as possible for you. As a seller, you might be thinking, okay, it's good for me to know this information, but I've already bought my house, so what does this have to do with me? Well, it has a lot to do with you, because the type of loan that the buyer who's looking to purchase your home is using is directly going to impact your sale. FHA loans have stricter appraisal requirements, which could mean additional repairs before closing. And VA loans might come with extra paperwork or requirements, and then grant programs could add delays because sometimes it takes a little bit of time to get those funds together. So if you understand as a seller what the buyer on the other end is going through, you and your agent can evaluate offers more strategically and choose choose the best offer that aligns with what your goals are, because the highest offer is not always the best offer. But at the end of the day, the loan that you choose or the loan that your buyer is using is going to be one of the most important decisions in the home buying process. It's going to affect their monthly payment, it's going to affect your closing timeline, and it's even going to affect your ability to negotiate in some circumstances. So guys, if you have questions about loan types, whether you are buying or selling, drop them in the comments. I try to do my best to cover everything except jumbo loans, but if there's something else that you're interested in learning about or you want me to do a deep dive into, just let me know. Drop a message in the comments and I'll cover it in a future video. Okay friends, so now that we've covered loan types, let's bring it all together and let's talk about what affordability actually looks like in real life. Because at the end of the day, it's not just about what you can qualify for, it's about what fits your budget, your lifestyle, and your financial future. And that's something that we don't ever want to forget about. So let's take a real example. I'm going to be listing a home soon in Suffolk, Virginia. For simple numbers, let's say I'm going to price that home at $500,000. And what we're going to do is take that example and break that down using 3 different loan types to see how much each option really costs per month. So we're going to start with an FHA loan. Now, if you put down 3.5%, your down payment is going to be $17,500, which is going to leave your loan amount to be $482,500. Because FHA loans have lower credit score requirements and are considered higher risk, the interest rate tends to be higher. So with an estimated 7.25% interest rate, your monthly mortgage payment, including the PITI that we talked about, would be around $3,800. Now let's look at a VA loan. VA loans allow you to purchase a home with no money down, so your loan amount would be the full $500,000. The interest rate is usually lower than FHA because VA loans are backed by the government, which reduces the lender's risks. At an estimated 6.75% interest rate, your monthly payment is going to be around $3,600. So compared to the FHA, that's going to save you about $200. Now lastly, let's look at a conventional loan with 10% down. If you put down $50,000, your loan amount would be $450,000. Conventional loans generally offer lower interest rates when you put more money down, so let's just estimate 7%. With taxes and insurance included, your monthly payment would be around $3,400. So what does this all tell us? The type of loan and how much you put down significantly impacts your monthly payment. Even though VA loans require no down payment, they still have a competitive monthly payment because of the lower interest rates. Now, FHA loans, while great for buyers with lower credit scores and smaller down payments, they typically have the highest monthly payment due to the higher interest rate and the perceived risk and the required mortgage insurance. Now, let's compare this home that I'm about to put on the market to just a home in Virginia Beach. If we took a standard home that was priced at $350,000 and we run the same loan scenarios, here's what that same home would look like. With an FHA loan at 3.5% down, the down payment would be around $12,250, making the loan amount $337,750 with a 7.25% interest rate. Then your monthly payment would be about $2,700. For a VA loan with 0% down, the loan amount stays at $350,000, but at a 6.75% interest rate, the monthly payment would be around $2,500. Now with a conventional loan and 10% down, you'd be putting down $35,000, leaving a loan amount of $315,000. With an estimated 7% interest rate, your monthly payment would be about $2,300. Now, even though this home is $150,000 cheaper, the difference in property taxes and insurance mean the payment does not drop as much as you might expect. The key takeaway here is that in Suffolk, buyers often get more house for their money because home prices tend to be lower than home prices in Virginia Beach. And this is why Suffolk has become a popular choice for buyers looking for larger homes, more land, or newer construction at a more affordable price point. But let's shift the focus to the long-term impact of your mortgage payment. Regardless of which loan type you choose, your payments are going to be structured using what we call an amortization schedule. Say that 3 times fast. That means in the early years of your loan, most of your monthly payment is going to go towards your interest rather than paying down your actual loan balance. This is why on a 30-year loan, you're not going to see a big dent in your principal balance until after the first 5 to 7 years. Those first several years, you're strictly paying on your interest. But here's something a lot of buyers don't realize, that making just one extra mortgage payment per year could shave 5 to 7 years off of your loan and save you thousands of dollars in interest over time. Even small payments add up. So whether it's rounding up your monthly payment or applying a tax refund towards your mortgage, that can make a huge difference in the long term, in the life of your loan long term. Now, for sellers, understanding how buyers qualify at different price points can help you price your home competitively. A buyer approved for a $500,000 house with an FHA loan may have a higher monthly payment than a buyer with a VA or a conventional loan at the same price. These differences can affect how fast your home sells and whether a buyer will need seller concessions to cover their closing costs. Now, it's also important to know that FHA, VA, and conventional buyers may have different appraisal and loan conditions that could impact your closing timelines. FHA and VA loans require stricter appraisals, which means sellers may need to make repairs before the loan is approved. Now, conventional loans, on the other hand, they're usually a little bit more flexible. Now, friends, now that we've broken down real affordability and how loan types affect what you pay each month, let's move into the next section where we're going to talk about interest rates, what determines them, how they fluctuate, and why they play a huge role in your mortgage payment. Okay, so now that we've talked about loan types, monthly payments, and what affordability really looks like in real life, there's one major factor that's still going to affect how you pay for your mortgage over time, and that's your interest rates. Interest rates are a big deal. Over the last couple of years, that is the biggest conversation that I've heard in real estate. Even a small change in your interest rate can increase or decrease your monthly payment and the total amount that you're going to pay over the life of your loan. So what I want to do today is I want to break down how interest rates work and what determines them and how you can get the best rate possible, even in a situation where interest rates are continuing to rise. First, let's talk about what actually determines your mortgage interest rate. There are going to be three main factors that's going to affect the rate that a lender is going to offer you. The first thing is going to be your credit score. The higher your score, the lower your interest rate. That's because lenders see high credit scores as a sign that you are a responsible borrower, which means they take on less risk when they're lending to you. Now, if your score is low, lenders are going to charge a higher interest rate to offset the risk. Does that make sense? The next thing that's going to affect your interest rate are the market conditions. Mortgage rates change daily based on the overall economy, inflation, and what the Federal Reserve does with interest rates. When inflation is high, mortgage rates tend to go up. When the economy slows down, like it did in COVID, interest rates usually drop. Now, the third thing that's going to make up your interest rate is going to be the loan type and the loan term. The type of loan you choose and how long your mortgage is will also impact your interest rate. For example, FHA and VA loans typically have lower rates than conventional loans, and 15-year mortgages usually have lower rates than 30-year mortgage loans because the lender is taking on less risk long term. But let's talk about the difference between a fixed rate mortgage and an adjustable rate mortgage. You'll hear the term called an ARM when you're thinking about an adjustable rate. A fixed rate mortgage means that your interest rate stays the same for the life of your loan. So if you lock in a rate at 7% today, it's going to be 7% in 30 years, no matter what happens in the economy. This is going to give you the stability and predictable payments, which is why most buyers choose a fixed rate loan. Now, an adjustable rate mortgage, or an ARM, on the other hand, has a lower interest rate for the first few years, typically 5, 7, or 10 years. But then after that, the rate is going to adjust based upon the market conditions. So if rates go down, then your payment could decrease. But if rates go up, then your payment could increase. ARMs can work well for buyers who do not plan to stay in their home long term, but they come with more risk because you don't know what your payment's going to be after that initial period. So that's something that you definitely want to discuss with your lender and make sure that you are very well aware of. Now let's talk about why shopping your interest rate is so important. A lot of buyers don't realize this, but lenders don't all offer the same rates. They are not the same. Your rate can vary depending on which lender you choose. And this is why it's a smart idea to get quotes from at least 2 to 3 different lenders before deciding on who you're going to go with for your mortgage. Now, in another video, I also talk about trying to determine if the lender is receptive, if they're knowledgeable, if they communicate well. But the interest rate is huge. So even a small difference in your interest rate can can save you thousands of dollars over time. So let's put this in perspective with a real world example. Let's say you're buying a $400,000 home and you're getting a 30-year fixed rate mortgage. Now, if your interest rate is 7%, your monthly principal and interest payment would probably be around $2,660. But if you got a rate of 6.5%, that payment's going to drop to about $2,530. And if your rate was 6%, your payment would only be about $2,400. That's a difference of over $250 a month just based on a 1% change in the interest rate. So over 30 years, that adds up to tens of thousands of dollars. And that's why timing matters, my friends. If rates are high, some buyers choose to wait for the rates to drop before buying. But what has happened is that the rates have not dropped, and now home prices have gone up and they've priced themselves out of the market. Because while you're waiting to get you a better rate, home prices can go up, which can cancel out any savings that you would have had. The key is understanding that you can always refinance later if rates drop, but if prices continue to go up, you can't go back and buy a home later at today's prices. And trust me, some of my clients are kicking themselves for not buying 2 years ago. So here's the bottom line. Your interest rate directly affects your mortgage payment and the total cost of your mortgage. The rate you get depends on your credit score, the economy, and the loan type you choose. Fixed rates offer stability, while adjustable rates can be risky. Shopping around for the best rate can save you thousands over time. And if rates are high when you buy, refinancing later can help you lower your payment. But now that we've covered interest rates, my friends, let's walk through the mortgage process step by step so you know exactly what to expect from pre-approval to closing. Okay, friends, so far in our Mortgage 101 Masterclass, we've covered loan types, we've covered affordability, we've covered interest rates, but now what I want to do is I want to walk you through the entire mortgage process step by step so you know exactly what to expect from pre-approval to closing. Shameless plug. A lot of buyers feel overwhelmed because they don't know what happens next. But when you understand the process, you can move forward with confidence and you can avoid unnecessary stress. And trust me, my entire goal for you is to help reduce your stress. So the first thing that we want to do is the pre-approval. Before you start house hunting, you need to get pre-approved. Say it with me. Pre-approval. This is when a lender is going to review your credit, your income, your financials to determine how much you can borrow. A pre-approval letter shows sellers that you are a serious buyer, and in today's market, most sellers are not going to accept an offer without one. And I'm not going to take you on any property tours without one. Okay. Well, once you're pre-approved, you can start working with your real estate agent, me, to find you a home that fits your budget and your needs. When you find the one, you're going to submit an offer to the seller, and once your offer is accepted, you're going to move into the next phase of the process. And the next phase of the process is going to be the appraisal, which is actually going to protect the lender's investment. Now, at this stage, the lender is going to require a home appraisal to determine the property's market value. The appraisal ensures that the lender is not loaning more money than what your house is worth. Now, if the appraisal comes in at or above the purchase price, there are going to be no issues. But if the appraisal comes in lower than the agreed upon purchase price, then we may need to negotiate with the seller. We might have to pay the difference, or we have to adjust your loan terms. Unlike a home inspection, which protects the buyer, an appraisal is actually going to protect the lender by ensuring that they are making a sound financial investment by lending you the money. Once the appraisal is complete, your loan is going to go into underwriting. This is when the lender is going to do a final review of your financials to make sure that nothing has changed since you were pre-approved. Now remember, during your pre-approval, that's when they verified all of your documents, all of your income, and all of that. But during underwriting, the lender is going to verify your credit, your employment, and financial documents again. They're going to confirm that the home meets all loan requirements, especially if you have an FHA or a VA loan. They may request additional documents time and time again, but this is where people get frustrated and where mistakes usually happen. So here are the things you want to avoid. Don't open up any new credit cards or take any debts. Don't make any large deposits or withdrawals. Do not change your jobs. Do not change your jobs. Do not do anything until you have officially gotten your clear to close. Now, on closing day, that's when we're going to finalize the loan. And that's when you're going to sign all of the necessary documents so that we can finalize your mortgage. And here's what happens on the mortgage side during the time of closing. You're going to review and sign all of your loan documents. You're going to pay any required closing costs unless they're already rolled into your loan. The lender is going to fund your loan, and then the title is going to be transferred to your name. Now, once you're done, the home is officially yours and you have gotten your keys. You see, the bottom line is this, friends. Even though the mortgage process might seem a little bit complicated, and if you've never gone through it before, it can be a little nerve-wracking, but when we break it down step by step, can you see how manageable it is? So let's just do a quick recap. The first thing you want to do is get your pre-approval before you start looking at houses. The second thing you want to do is find a home and make a great offer. Third, we're going to go through the appraisal process to confirm the value of your home. We're going to then complete the underwriting process and get a final loan approval. Finally, we're going to close your home. We're going to sign all of the loan documents. And now that we've covered the full mortgage process, let's wrap up the Mortgage 101 Masterclass with a final recap of everything that we're learned. You ready? Whew! Take a deep breath. Guys, we've covered a lot in this Mortgage 101 Masterclass. And so what I want to do is, first of all, thank you so much for sticking with me. I hope you learned something. But let's go over the key takeaways to make sure that you're going to walk away with a clear understanding of the home loan process. First, what is a mortgage? We discussed exactly what a mortgage is and how it works. It comes with terms, it comes with interest, and a structured repayment plan that can last 15 to 30 years. The next thing that we went through was the approval process and why it's important to get a pre-approval before shopping for a home. A pre-approval is your financial green light. It's going to tell you exactly how much you can afford, and it's going to show sellers that you are a serious buyer. So everybody say it with me. Get the pre-approval first. Now, we talked about the difference between a pre-qualification and a pre-approval. They not like us. They not the same. Pre-qualification is a basic estimate of what you might be able to borrow, but a pre-approval means a lender has verified your financial information. Now, after we talked about the pre-approval process, we talked about what actually makes up your monthly mortgage payment. Many buyers focus only on the loan amount, but your mortgage payment includes more than just repaying the money that you borrow. So we talked about the PITI. Now, after that, we discovered the different types of mortgage loans and how they affect both buyers and sellers. Choosing the right loan is critical because it determines your down payment, your interest rate, your monthly payment, and even how competitive your offer is compared to other buyers who are looking at that home. Now, sellers should also pay attention to loan types in offers because some loans require stricter appraisals, more paperwork, and longer closing times. And then we talked about how interest rates work and why they are a key factor in your mortgage payment. A lower interest rate can save you thousands over time, while a higher interest rate can significantly increase your monthly costs. Your credit score, the loan type, and the market conditions all are going to influence the rate that you're going to be offered. Next, we broke down real-world affordability using home price examples in Suffolk and Virginia Beach to see how different loans impact monthly payments. So even if two homes are priced the same, the loan type, the interest rates, and down payments can make a huge difference in the monthly cost. Amortization means that in the early years, most of your mortgage payment is going to go toward the interest and not the principal. And making one extra payment per year can shorten your loan term by several years and save thousands in interest. Now, finally, we walked through the 5 key steps of the mortgage process so you know exactly what to expect when you go under contract. Friends, buying a home is one of the biggest financial decisions you'll ever make. The key to success is being prepared, informed, and working with the right professionals. Listen, I can't stress this enough. Do your work up front. If you are thinking about buying a home, even if it's in the not so near future, start with your pre-approval. At least you have a baseline so that you know the work that needs to happen in order for you to qualify. And if you are selling, understanding loan types and buyer qualifications can help you evaluate offers more effectively. Now, if you guys still have questions, just reach out. Whether you need help understanding loan options, affordability, or the home buying process, I'm here to guide you every single step of the way. If this masterclass was helpful, let me know what other topics you want me to do a deep dive into next. Your home buying journey does not stop here, friends. I am committed to helping you every single step of the way. Keep in mind, I'm connected with rockstar lenders all throughout the United States. So if you found my video but you do not live in my area, that's okay. Hit your girl up. You can still schedule a consultation below or text me, and I'll happily connect you with someone who I personally trust that has the knowledge and the expertise to help guide you through your real estate journey, whatever that looks like. Friends, thank you so much for sticking through this Mortgage 101 video. I hope you learned something. God bless you.